Okay, you are welcome to today's meeting, and hope you are doing well. And as I told you earlier, today we'll be looking at business finance too. And our main focus today is going to be looking at chapter 2 of your handouts, where we'll be looking at portfolio building and diversification. Portfolio building and diversification. So you open to your pages, I think somewhere in page 24 of your handout, you see portfolio building and diversification. So that is what we'll be looking at basically today. Now, when somebody talks of a portfolio building or the principle of diversification, we've always been hearing these quotes. You don't put all your eggs in one basket. Don't put all your eggs in one basket. So in an investment, when we are talking about portfolio building, we mean you don't put your eggs in one basket. Why are they saying that? You know how precious and how fragile egg is. When it breaks, that is it. You can't get it again. So it is the same thing that is applying to investment. When you pump into your money into an investment vehicle and it go waste, you are not going to get that money again. That is what it is. It's like gambling. Investment is like gambling. So you gamble and the money comes, fine. The money doesn't come, it's fine. There you are. So if all your money you have on you is, let's say, 1,000 Ghana cedis, then use all the 1,000 Ghana cedis to go and do men's gold. And men's gold has collapsed. It means that there is no way you are going to get that money again. You are down to ground zero. But for example, if you use 500 Ghana cedis to go and pump in men's gold, you use 200 Ghana cedis to go and buy government shares, you use 300 Ghana cedis to go and buy bonds. At least if men's gold has run away with your 500 Ghana cedis, at least you have another 200 and 300 somewhere that you can use for cushioning. So by so doing, the 1,000 that you have is the egg we are talking. You have not put all those eggs in either men's gold or in that shares or bond. You have spread it. So any good investor does what we call diversification and building of what? Portfolio. Any good investor you see will spread his investment. So at the end of the day, when you are losing here, you are gaining here. So let's take somebody like Kwame Osei Despite. Kwame Despite is having a travel and tour business. Kwame Despite is having a pharmaceutical company. Kwame Despite is having a TV station. Kwame Despite is having a restaurant. Kwame Despite is, let's say, having a hotel. Now, if all the lifetime money Kwame Despite is having is what he has pumped into hotel building, or let's say his hotel is golden to you. Today that coronavirus is at stake and then hotels are not working, you can see that Kwame Despite to be in ground zero. Or let's say Kwame Despite has pumped in all his money in a travel and tour business. Today that the travel and tour business is not going on, planes are not flying, aircrafts are not going, coming, he is ground zero. Are you getting it? But if he has diversified his portfolio, some in the airline industry, some in the hotel industry, some in the transport industry, some in the pharmaceutical industry, you can see that the investment in the airline industry will be suffering by now, but the investment in the pharmaceutical industry will be booming by now, because this is the time we need pharmaceutical products. This is the time we need pharmaceutical items. So his investment in the pharmaceutical industry will be bringing him more income. So at the end of the day, the loss he is suffering or the loss he is making in the hotel and the travel and tour business, he will not be feeling it. Why? Because he has diversified his portfolio. And that is what we mean by portfolio building and diversification. So at the end of the day, when you spread your investment across several investment assets, it is called diversification. Now, why do we diversify? We diversify because of one thing. And the reason why we diversify is what we call risk. It is because of risk. That is why every investor diversifies his or his portfolio. It is because of risk. That is why every investor, when you are going into an investment, you ask questions, you tread cautiously. So investment, you say we take what? Calculated risk. Now, this risk we are talking about, they are of two forms. We have diversifiable risk, and then we have non-diversifiable risk. We have what? Diversifiable risk, and then non-diversifiable risk. When we say diversifiable risk, what do we mean? A diversifiable risk is the risk that we, the investors, we can influence. Is the risk that the investor can influence by building what? Portfolio, or by spreading his investments. So it gives you, the investor, the opportunity to take decisions that will help you mitigate the diversifiable risk. Are you getting it? Now, let me cite an example. When we say diversifiable risk, another way another explanation somebody can say that a diversifiable risk is the risk that the investor has control over. So you have control over that risk. And when you avoid that risk, you can avoid it easily. But non-diversifiable risk is the type of risk that the investor does not have any control over. So you, the investor, I don't have any control over the non-diversifiable risk. And the non-diversifiable risk, they can also be called market risk. So you can either hear diversifiable risk, non-diversifiable risk, and the non-diversifiable risk can be called what? Market risk. Market risk. It can also be called systemic risk. Non-diversifiable risk can also be called what? Systemic risk. So I've given you three names for the non-diversifiable risk. So I say it can be called non-diversifiable risk, market risk, or systemic risk. Now, the diversifiable risk can be called non-systemic risk, or somebody can say unsystemic risk, whichever one you want to say. Non-systemic risk. That is another name for diversifiable risks. So as I said, diversifiable risks are risks that you as the investor, you have control over, and you can take investment decisions to reduce their impact on your investment. But for the market risk, you, the investor, you have no control over those risks. And so therefore, you cannot take decisions to influence their occurrence. Now, example of a diversifiable risk is number one, let's say workers' agitation. Workers' agitation. Why will workers be agitated or workers strike? If workers goes on strike, it will affect the business. And so therefore, the risk of the business not going on or the chances of the business being affected is very high. As an investor or as an employer, what decisions will you take so that workers will not go on strike? Because you know, when workers go on strike, it will affect the business. So I'm explaining the diversifiable risk so that you understand. So what are some of the decisions as an investor you take so that this risk will not happen? Now, while workers agitate, maybe salaries are too low, maybe salaries are delaying, or maybe working conditions are not good, and so on and so forth. So when you make working conditions good for workers, when you give them good salaries, when you make them feel good, will they go on strike? No. So at the end of the day, as an employer, you have diversified that risk. You have shifted the burden of the risk on you to another person. That is diversifiable risk. So as an investor, you have portfolio. So you were like, oh, okay, what will I do so that I'll not do this, so that I'll not do this. So at the end of the day, you know that, okay, when I pump in this money here, this is what will happen. I pump in this money here, this is what will happen. Okay, let me pump in this one here. Let me pump in this one so that if this is happening here, this can be happening here. You are diversifying the negative impact of the investment. But a risk like inflation, interest rates, do you have control over it? Government policies, do you have control over it? You don't. So at the end of the day, the forces of demand and supply in the market that affect interest rates, that affect inflation, that affect prices of goods and services, you as an investor, you have no control over them. So the reason why we are going to understudy portfolio building and diversification is because of the non-diversifiable risk. So it is because of the non-diversifiable risk, that is why we have investments. Because those investment risks, you have no control over them. So if you know that interest rates are high, will you go and borrow money to go and do investment? No. If you know interest rates are low, will you go and borrow money for investment? Yes. So before you take an investment decision, you assess and analyze the non-diversifiable risks that are affecting or that might be affecting your investment before you take a step. So at the end of the day, we build a portfolio using investments that are inversely related. This point is very, very key. We build a portfolio with investments that are inversely related. What are we saying? When one investment is gaining, another investment is losing. So the loss you are making here will be compensated by the gain you are making here. I get it. So at the end of the day, you diversify by building a portfolio. So you can only diversify your investment when you build a portfolio. And as I tell you, portfolio is a collection of investment selections. I get it. So you are bringing in several investments to into one pot or into one group. So you bring this investment here, you bring this investment here, then you classify them as one group of investment, and you carry on. If you have any question, as I told you, you look at the down part of your participant screen. So you go to manage participants or participants, then on the right hand side of your name, the three dots over there, you raise up your hand over there, and then I will call you. Now, when you go to your book, they say portfolio diversification is the investment in several different class of assets or stocks of sectors of stock. I get any. So you are pumping in your money into different type of assets in different sectors, and that is what we call diversification. I get any. Good. Now, as I told you, portfolio is a group of stocks or bonds held by an investor. So you have part of the money in bonds, you have part of the money in treasure bill, you have part of the money in real estate, you have part of the money on and on and on and on and on. So at the end of the day, you take an informed decision on how you are going to spread this money so that you can make the best out of that money. Now, how then do you build, or what are some of the things you must take note of when you are building a portfolio or you are diversifying? Number one, I want to share this particular screen too with you so that you can see what I'm saying. So, how do we build a portfolio? Now, in an attempt to build a portfolio, number one, you must identify the investment weights. You identify the investment weight. And when we talk about the investment weight, what do we mean? How much or what proportion of the money is going to investment A, and what proportion of the money is going to investment B, and what proportion of the money is going to investment C is the individual investment weight. So if 20% of the money is going to A, 20% of the money is going to C, 20% of the money is going to D. So out of the 100%, how are you allocating it in terms of proportion to the several investments you identify or you want to pump in the money with is the investment weight. So if you know you have 1,000 Ghana cedis and you want to pump in 500 into men's gold, it's your decision. You want to pump in 200 into treasure bill, it's your decision. You want to pump in 100 into this, it's your decision. That is your decision. Number two, the second point you must take note of is the relationship between these investments. That is the correlation coefficient. How are they moving? I told you that we invest in negative related investment or inverse related investment. So we build a portfolio using inverse related investment. Now, why are we saying that? If all of them are positively related, when you are gaining in all. When you are losing in all. So the chances of you becoming successful and the chances of you becoming non-successful is 50-50. Because if everything goes down, you won't come back again. If everything goes up, you are heated. I get it. And that risk, nobody will be willing to take that risk. But when they are inversely related, today you will have investment in Ghana. Tomorrow you have investment in Turkey. Tomorrow you have investment in Germany. So if today the Ghana economy is not performing well, at least the Turkey economy is performing marvelously well. So when you lose 1 in Ghana, you are getting like 3 or 4 in Turkey. So you will not be feeling it. Are you getting the scenario? Good. Then you determine the individual investment risk by identifying their covariance. Now, what do we mean? You identify the individual investment risk. So the investment that you have identified, what is the risk associated to this investment? What is the risk associated to this investment in that order? The standard deviation is what we are talking about. So at the end of the day, you do that by also identifying the co-movement that, okay, if investment A make a loss by 10%, by how much is investment B making profits? If investment C is making a loss of 20%, by how much is investment D making profit? So you want to find the coefficient of variation among this investment so that you now come to the conclusion that whenever I make a 10% loss, I have made another 20% gain somewhere. So in a nutshell, at the end of the day, anytime, any day, you are making a 10% profit, because the 10% loss will be compensated by another 10% loss profit somewhere, and leaving 10% in that 20 we are talking about. Then the final one you are supposed to look at before building a portfolio is the portfolio risk. Now you know the individual risk. So what is the portfolio risk? I get it a scenario. So what we are trying to talk about is that, okay, when I take your class, for example, each and everybody in the class there is an individual investment. So this individual investment in your class, I want to give everybody money to set up a business. The money I have to give everybody, I'll identify all of you individually. Then I give 10% of the money to this person, 5% of the money to this person, 20% of the money to this person. Then I'll now look at each and every one of you who will be making profit at this time, who will be making loss at this time, who will be making profit at this time, who will be making loss at this time. Then I'll put all together, because I don't expect everybody to be making profit at a go. I don't expect everybody to be making loss at a go. So those who are making profits will be, those who are making loss will be compensated by those who are making profit at a particular point in time. The next day, the table turns around. Those who were making profit yesterday might be making loss today. So those who were making loss yesterday will be making profit today. So it will be compensating each other. Now, the covariance. By how much profit will you make if this person make loss? By how much loss will you make if this person make profit? Then you put all those things together. Then at the end of the day, I sum up everything. Then I'll say that, oh, year 2020 level 300 batch, chai, the risk associated to them there is very high. Don't go there. Or year 2020 level 300 batch, the risk associated to them is very low. So as for them, go with them. That is where you can now take a final decision and a final conclusion on the investment, and then you now pump your money into the investment proper. So that is how we build a portfolio, or the steps you follow in building a portfolio. Now, let's go back small. As I indicated, so you come here. I wanted to explain this diagram for you. So illustration indicating a diversification. So the company specific risk is also called firm specific. That's what I was talking about, the diversifiable risk. So from here to here, is the diversifiable risk. From 0.35 to 0.20 here are the diversifiable risk. Are you getting it? So it is called diversifiable risk or non-systematic risk or firm-specific risk or unique risk, because the risk associated here is unique to every company. So the reason why workers will go on strike in company A might be different from the reason why workers will go on strike in company B. But the market, the risks that affect the market is across board. So that is the diagram they are illustrating here. Then they came down further to give you a proper understanding of them. So the things I was saying, diversifiable risks can be called non-systematic risk, firm-specific risk, or unique risk. And then the non-diversifiable risk can also be called systematic risk or the market risk. In between these risks is where we have our portfolio risks we are talking about. So your portfolio risk should not be higher than the market risk and should not also be lower than the firm specific risk. It should be in between. In between. That is all what I wanted to explain for you. Now, in an attempt to identify a portfolio risk, last time we have looked at how to calculate expected return. Now, at the end of the day, in an attempt to calculate a portfolio risk, you should be able to know the investment expected return. So individually, how much is everybody going to be making? Individual is the expected return. You must also know the individual risks. What are the individual risks associated to this investment one by one? You must be able to know all those ones. Once you know that, the next thing you will know now is then you know the weight, then you start your diversification. So I want us to refresh our minds small. We are going back to the very first illustration that we have looked at. The very first illustration that we have looked at on expected return. So if you can remember this illustration that we have looked at somewhere in chapter 1. The question is on, go to your page 8 in the handout. If you have the handout, you go to page 8 in the handout. The question is there. The question we use to solve this particular illustration here. So that I want us to refresh our minds more on that question so that you understand what we are going to do now. So I'm moving straight to my page 8 of the handout. So this question, this particular question is what we are going to be using in dealing with building the portfolio and everything. And it was what we used to do the first illustration. And I told you in the unit 1, what we have looked at is called stand-alone investment. We have minimized or we have assessed each and every investment on their own merit. Each and every investment on their own merit. So at the end of the day, we say that, okay, for investment A, these are the individual returns. For investment B, these are the individual returns. And these are the weights of the investment. And we were asked in that question to find the expected return. And then we said that to find your expected return, it is equal to your what? Individual return multiplied by the probability. So the probabilities of the investment multiplied by the what? Individual investment return. So when you look at that question, we find the expected return for amusement park, and we said that the 0.1 multiplied by the negative 15% plus the 0.3 multiplied by the negative 0.5% plus the 0.4 multiplied by the 10% plus the 0.2 multiplied by the 30%. And at the end of the day, when we finished everything, we had our individual expected return to be 7%. When we go to that of the Sky Resort, we did the same thing. The 0.1 multiplied by the 35%, the 0.3 multiplied by the 15%, the 0.4 multiplied by what? The 5%, the 0.2 multiplied by what? The negative 5%. And at the end of the day, we came to the conclusion that our individual expected return is 9%. From there, we were asked to find the standard deviation. So in an attempt to find the standard deviation, we said standard deviation is equal to what? The variance squared, or the square root of the variance. So we went ahead and studied how to find the variance. So we said to find the variance, it is equal to the same probability multiplied by the expected return you had for investment A, which is 7%, minus investment A's first required return, which is negative 15%. So we say the 0.1 bracket open, the 0%, 7%, that's 7%, minus 15%. So we said minus is what? Positive. So we place a positive here. There is squared. 0.3, 7% minus 5%. So minus is positive. 0.4, 7% minus 10%. Then we square. 0.2, 7% minus 30%. And when we finished, we had our variance for amusement park to be 0.0201. We went ahead and then we did the same thing for the Sky Resort. And the Sky Resort too, we also have 0.0124. And I've advised you that when you are writing the 0 point and things, you must be careful so that you don't make a mistake. Finally, we went ahead and find our standard deviation. And then we square root the variance we had from here, and we had 14.18% as the standard deviation for amusement park. We went ahead and we found the standard deviation for Sky Resort, and then we have 0.1135. That is 11.4% as the standard deviation for Sky Resort. So this was where we have ended in our lecture 1, where we find expected return for investment A, expected return for investment B, standard deviation for A, standard deviation for B. And we went ahead and did the standard deviation straight away and said that, okay, at the end of the day, you can even put everything in the square root over here. So you put everything in the square root over here, then you get the answer straight away. So once you can do this one, you are also gone. So basically, this was where we ended up in our lecture 1. If you have any question, you raise up your hand. If you don't have any question, I have a question. So from our lecture 1, we got to know that expected return for amusement park is 7%. Expected return for Sky Resort is 9%. Standard deviation for amusement park is 14.8. Standard deviation for Sky Resort is 11.14. So we are going to transfer the knowledge we had in chapter 1 into chapter 2. You must take note. We are going to transfer that knowledge from chapter 1 into what? Chapter 2. So it means that when we are not strong on that illustration, we are going to be having problems with this particular illustration. Now, when you have been given a question or in an attempt to build a portfolio, number 1, you must know your portfolio expected return because you knew your individual expected returns. So you should be able to also identify the portfolio expected return. That is the group investment return. So for the whole level 300 accountancy 3 class, if I pump in 100,000 Ghana cedis, how much am I going to get? Given that Delphina will give me 200 Ghana cedis, Richmond will give me 100 Ghana cedis, Mr. Tete will make a loss of 50 Ghana cedis, Sadiq will make a loss of 20 Ghana cedis in that order. So at the end of the day, how much am I getting from the group is the portfolio expected return. And portfolio expected return is giving us, the formula is giving us the weight of investment I multiplied by the expected return of investment I plus the weight of investment Y multiplied by the expected return of investment Y. So you must know the weight, the proportion of the money you are pumping into investment I. You must also know the proportion of the money you are pumping into investment Y. Then you look at their individual investment return. Then you multiply everything, sum everything together, you get your answer. Or to write it in a simple term, we say weight of A multiplied by expected return of A plus weight of B multiplied by expected return of B. And you can write the second formula